And joining us now is Mark Luschini, Janney Montgomery Scott, Chief Investment Strategist. Great to see you. All these records, Mark, what do you make of it? And can we build from here? Or do you think after you see records like this that stocks maybe are due for a pullback?
Well, Julia, I think longer term, we can certainly build on these gains, but we're ripe for a pullback. We've had an advance that's quite extended at this juncture. Really looking back all the way from the lows of October of last year, where we've had very little corrections along the way of any depth or order of duration. And so as a consequence, we're ripe for something to come along. What might catalyze it? Who knows necessarily, other than the fact that valuations are certainly not cheap. And as a consequence, it gets to the point where stocks are priced for only good outcomes or expectations being met. Of course, that was the case today with regard to the inflation reading, with that, while at generally face value, it came in a little hot, kind of confirming what we saw earlier from the CPI reading. Nonetheless, it wasn't in excess of expectations. And that seemed to be enough for market participants to stay with the trade that's been working so far this year, which is long stocks, particularly led by some of those tech-related companies.
Any concerns, Mark, about the narrowness of the market's move here, and do you expect that to broaden?
Well, I would think if we continue to see the evolution of the economy work in the way it's been working, certainly over the last 12 months, and at least even so far here this year. Right now, the Atlanta Federal Reserve's GDPNow tracker just came out with a print this morning that showed this deep into the first quarter of 2024, 3% annualized growth. Once again, indicative of the kind of momentum that suggests the aversion of a recession is increasingly possible. I think in that environment, which inflation at the same time continues to grind down and toward the Federal Reserve's target, should allow for a broadening of the economy. In other words, seeing the sectors that were mentioned by the previous reporter, like industrials and financials particularly, beginning to take on a leadership kind of role, if only to match that of technology, if not to exceed it. In the meantime, where we did not see that, and right now the evidence is still a little bit out as to whether we're going to see that evolution, what we're seeing is that, again, the kind of narrowness of the market that last year was renowned for, and it is a little bit troublesome not to see that participation, not just by sectors, but also the number of stocks even within the S&P 500 going on to achieve new highs, or seeing the participation being matched from that of higher beta sectors, like, for instance, the Russell 2000. So we're watching for that to evolve, but in the meantime, staying long in this market, even with the narrowness as it has clearly been rewarding, and we think it's likely to continue to, because we don't see any imminent kind of economic related activity other than that which we all know about being a known unknown, geopolitical concerns that can necessarily take the legs out from underneath this market for any, again, order of magnitude or sustained basis.
So, Mark, where do you stay long then? Do you stay long within those tech leaders that have been doing so well? Do you also stay diversified, and where are you looking right now?
Julie, it's hard to argue against that kind of leadership. If you look at the trends that are in place in comm services, obviously led by names like, Facebook, Meta, and Google, Alphabet, certainly Amazon, and even with the resumption in some advance in Tesla, helping to lead the consumer discretionary sector, at least on a capitalization weighted basis, and tech in general continues to be, again, rewarded for being high growth areas, high quality names, iconic names, in fact, with fortress balance sheets that are being rewarded in this environment more so than their more cyclical brethren or lower quality brethren. So yes, definitely, but we would also accompany that by two of the sectors that were mentioned earlier, both in my comments and by the reporter, and that is, of course, financials and industrials, that also show similar signs of life with regard to current trends that are seemingly well supported at this juncture. Other cyclical sectors, basic materials, are showing some development. Energy looks like it's resuming some kind of advance, but they're still somewhat embryonic in nature, and we wouldn't chase them yet at this juncture. And as for the defensive names that were mentioned, the REITs, the consumer staples, and utilities, the good news there from a bull is their lack of working in this environment is indicative of more of a more risk-on modality than risk-off. Otherwise, they would be usurping some of those aforementioned sectors in leadership, which they clearly are not at this juncture.
Mark, I also want to get your take on an interesting kind of debate I've heard around sentiment and just how you think about that. I have seen some strategists, Mark, they're looking at these sentiment readings and they feel like they're coming in hot and they believe they're kind of flashing a warning sign. I've seen other strategists kind of downplay that. How are you looking at it?
Well, it's a variable, Josh. I mean, like any other. I mean, I wouldn't necessarily bake a trade predicated upon sentiment. We know things can stay overvalued for quite a while, even when measures of sentiment, which is a softer gauge, or looking at some of the technical readings on relative strength, might show signs of overbought conditions. That doesn't mean they can't remain overbought for some period of time, or correct in time, meaning we move more sideways in a trading range rather than correct in price and have to see a deep pullback to restore some value and cool some of those more euphoric sentiment readings. Yes, anytime you see extremes in sentiment, whether it's ebullience or despair, those tend to be good times to be either trimming longs in ebullience or staging into longs in periods of despair. We're probably more on the side of improved sentiment that is tipping into areas of which we would encourage taking some profits and particularly looking to rebalance in something that, believe it or not, is outside the equity space, which is in fixed income. As yields have backed up here closer to 4.35 on the 10-year, we think it's an appetizing rate that on a go-forward basis should prove rewarding for investors in balanced accounts that are looking to augment equities with something that can offer a fairly appealing coupon at this point.
Yeah, most definitely. Mark, it's great to catch up with you. Good to see you. Thanks for joining us.
Thank you, Julie.